Welcome back to Lunch at the Market. That 3-day weekend would have been a lot nicer if it was 6, that's for sure. We had fun at our marshmallow roast, or smarshmallow roast, as my daughter calls it. The reality of the world's economies was here to greet us this morning. We have a new video up from James Altucher that you can view by going to either the Investor Education tab itself, where you'll actually find a couple of new videos, or you can go to Demystifying Wall Street and select James Altucher to view the video from his appearance on the Yahoo Finance Tech Ticker. He's extremely bullish and is looking for new all-time highs on the S&P by 2012. Today's manufacturing and construction numbers were not only good, but good enough to pull us out of a nosedive at the open. The issue, however, is that the news cycle is endlessly negative right now. It's actually downright terrible, and it's true, bad things are happening, but so are good things. It's important to try and just look at the facts isolated from how they're being presented in the news. On days like today, it's sometimes nice to just shut off the television, just read the news coming out so that there's no sensationalism, just you and the data. Canada is the latest country to hike rates, after Australia hiked their rates, and China undertook its own monetary tightening with upping the capital requirements for banks. We have at least 3 situations in the world in which the concern is inflation and not deflation. What does that mean? When you see inflation looming, it's the enemy of bonds. When countries start raising rates, it means that the bonds will start to price in expected inflation, leading to bond price depreciation. That's what's tricky about our situation in the capital markets right now. Clearly, stocks have been under tremendous pressure to do anything but go down for weeks now. Creates a fear and panic that could be felt in the air, at least during the trading day. The chorus of the bears is getting to be quite loud. The problem with your largest opposing asset class, bonds, are at a risk of seeing principal chopped off at the neck when banks raise the rates. And 2 foreign central banks have already done it. Does this mean that the U.S. will raise rates sooner rather than later? Probably not. The Fed is committed to avoiding double-dip recession, which means that seeing a little inflation is much better than slipping back into a deflationary spiral. But when the rates are finally moved, you will see bonds repriced instantly. Heck, when you see the language of the Fed change and finally remove the low rates for an extended period of time, you're going to see interest rate futures and bond prices start to react right then and there. That's the risk of owning bonds right now. So as we heard from James Altucher, who wrote an article for the blog, and then heard from James Altucher again, this video clip on the website, the answer to inflation is to own U.S. stocks. We'll throw in that holding stocks that pay dividends is like holding a bond that doesn't decline when inflation shows up, which doesn't exist right now outside of maybe tips. So looking for clean balance sheets, lots of cash, and juicy dividend is the #1 strategy we have right now and will have for the foreseeable future. Now, we had some pretty harsh comments today in response to our piece on the Spanish banks. We totally understand the risk involved in owning these banks. Maybe that's the issue. We understand how much capital we have at risk and are comfortable with our positions in all sorts of European banks. But in case we weren't clear, you are never to have more than 5 to maybe 10% of your holdings in any one position. I don't care if it's Apple or Netflix or something else that seems to go up endlessly. Not being diversified is a terrible idea and a surefire way to lose money, even for you traders. You may get lucky, that's fine. We'll leave the trading to you, but we will not be the reason that you get your butt handed to you because you went all in on any one of our speculative calls like Massey Energy, BP, Banco Santander, or even names like Joe's Jeans and Jamba Juice. The reason that we're able to talk about so many names is the result of the size of our portfolio. But it's very important that you keep diversification in mind always, every minute of every day. If you have a total wipeout of 10% of your portfolio over 40 to 50 years, it's really going to be a drop in the bucket. If you take a 50, 60, 70, or even 100% loss in your portfolio, even if you're young, you may never come back. It's impossible to beat inflation in any other way than the stock market. The housing market just showed us its true colors, so please, when we're pointing out the merits of a stock, do your homework. Our research is just a jumping off point to get you started on doing your homework. And it's advisable to work with someone, even if it's just another well-educated friend. It's very hard to do this alone. And we hope that we're a good partner, but keep in mind, working with a smart advisor is one of the best decisions you can make. Just make sure that they're smart. If they can't talk, the talk beyond your sales pitch. You're going to be talking to a salesperson of financial products, not an advisor. Thanks for tuning in today. Let's hope that this green in the Dow holds for the last hour of trading. We're looking forward to June expiration on the 18th. Only 13 trading days until we get there. At that point, we'll reload our covered calls and go to collect some more premiums. Have a great day, and we'll see you tomorrow. We'll be sending Brad to the Stock Twits event at the CME group in Chicago this week, so the schedule for lunch at the markets may be adjusted. If you're in Chicago or going to the event, don't forget to say hello to Brad.